Jack, would you like to come to the podium?
Hello. Question? Hello. Question? Yeah. Well, it's a great honor to be here with this audience. And Peter's comments, obviously, incredibly generous, but how appropriate that he should cite that 1972 article in this building. I'm going to try to explain momentum stocks, and I'm going to lean heavily on a notion of market bubbles in order to develop my explanation. It's really ridiculously simple. As most of you know, in 1965, Paul Samuelson published his proof that probably anticipated prices fluctuate randomly. It's always seemed to me that basically this was a definition of what a rational market is. I'm going to challenge that view this morning. Obviously, the very important paper, elegant paper, and one which, like many important papers, accomplishes what it does through some ingenious simplifications. My own view, which you will consider and you'll decide for yourselves whether you accept or reject it. My own view is that investors, value, investment value, is always about the future. The future's unknown. Thoughtful people, thoughtful, educated, sophisticated people will disagree about the future. So I want to contemplate a market in which rational investors can disagree I'd like to argue that basically the anticipations of proper investors fluctuate randomly. In other words, my test for a rational market is one in which individual investors are rational, and my test for individual rationality is that investors respond once and only once to new information about investment values. But because they will often disagree in those responses, market prices will basically be reflecting equilibrium in which not only investors' expectations are weighed, but also their wealth. An investor who disagrees sharply with the market or with most other investors, but has no wealth, in my system, has no impact on equilibrium prices. So I'm going to start by looking at what I call market bubbles, and I guess I'm using the term bubble in a private sense. It's not necessarily what other people would call a bubble, but basically it's a situation in which because investors, even rational investors, disagree, they make bets in the market against each other, basically zero sum, in a zero sum game. Then prices change, and because investors have made these bets, price changes reward some investors and penalize others. Wealth shifts from some of the beliefs in the market to a different set of beliefs. And because equilibrium prices in this kind of market in which investors disagree depend not only on their expectations but also on their wealth. Wealth shifts change equilibrium market prices. So you get changes in actual prices, wealth shifts, gains and losses resulting from changes in actual prices, and then changes in equilibrium prices reflecting the wealth shifts. And that clearly is a process that can feed on itself. If we start with changes in prices and end up with further changes in prices, what's to prevent this whole thing from repeating itself? Okay, now we've changed prices a second time. Doesn't this, or couldn't this, engender further changes, and then still further changes in equilibrium prices, and so on? And that is what I mean by a bubble, or more specifically, the situation in which this process doesn't peter out, but feeds on itself. And then I'm going to argue, of course, that this process with, say, for example, the level of the stock market as a whole has incidental consequences for particular common stocks. I bet on the specifics of a common stock. Boy, I really think this company has a fantastic management that most investors don't appreciate. And so I take a long position in that stock. Then the overall market goes up. Perhaps the stock has a fate of 1. The value of the stock goes up for reasons that had nothing to do with specifics, nothing to do with my wonderful insight into management. And now I've been rewarded for something that didn't require any skill or specifics on my part. But the result is that the people I bet against in betting on management in that company, they're penalized, I'm rewarded, I'm richer, they're poorer. We still disagree about the management of the company. And so, in my kind of market equilibrium, which depends not only on opinions but also on the wealth distribution associated with those opinions, the wealth thing has changed, okay, with respect to the specifics. The people who, like me, were enthusiastic about the stock, about the company's management, are richer. The people who were on the other side of that are poorer, relatively speaking. And because in this kind of market, equilibrium prices depend on wealth, the way the market values management of that company changes at that point. And it's changed because the general market level went up and the company had to pay up 1. Now, that's my argument for momentum stocks. All it takes is disagreement about specifics in a company that has some sensitivity to the general market level. And a bubble, a trainer type bubble, in the general market. Because if, with that kind of bubble, if it has some power to keep regenerating itself, then this impact on the specifics is going to happen not once, but again and again. And it's going to keep on happening as long as, 1, the bubble in the overall market continues, and 2, the disagreement about specifics continues. In trainers' view, that's all it takes to create a momentum stock. Now, it seems to me that why are some stocks momentum stocks and others not? Well, some stocks have big disagreements about specifics. Other stocks don't. So a general bubble in the general market is going to produce wealth shifts with respect to specifics on the stocks with the big disagreements and not on the stocks with the small disagreements, no disagreement. Well, anyway, that's the general pitch for the existence of momentum stocks. And because it's basically, it requires a bubble in the general market, I'll start my more specific discussion by taking a quick look at that. Do you all have copies of the folder? Okay. Basically, the first thing we consider is wealth shifts resulting from changes in the general market level, and my point is simply that the fractional change in the value of your bet is going to equal the fractional change in the market level, unless, of course, your bet is levered. So, very conveniently, I assume away the possibility of leverage. So then the question is, okay, fine. How big a bet do you make? The trainer says, well, let's make a kind of a bet in which the size of our bet is proportional to our disagreement with the market price, and inversely proportional to some sense of the likelihood that when we disagree with the market, that we are actually right and the market is wrong. So basically, there's a denominator here, which I'll call sigma squared. And to keep my argument as simple as possible, I'm going to talk about a level of modesty in this regard that is averaged across the whole population of investors. Because as it turns out, not surprisingly, it's kind of the average value that matters for my bubble mechanism. And you can see why. The more confident investors are about being right when they disagree with the market, the bigger the bets they're going to make, as indicated here. And consequently, the bigger the wealth effects, therefore the bigger the changes in equilibrium price, and so you can see, I think, why this measure of modesty is going to be significant to a bubble mechanism. Now let's consider what market clearing condition looks like. Basically, it says that there is some across the best of all investors. Again, that's reflecting disagreement with the market, modesty, and of course, the investor as well. The investor with the same disagreement, same modesty, and twice the wealth in these games going to make twice the bet. Then we have basically a market clearing condition that says that all the active bets in the market must sum to zero, and not very surprisingly for a mathematical sophisticated group like this, from that we derive an expression for equilibrium price. Now, actually, what we're interested in for our purpose in contemplating bubbles is a change in equilibrium price. So basically, we just take this expression, differentiate it, and note that after differentiating, we have, under the integral sign, the very thing that we derived on the previous page, namely the rate of change of the investor's wealth with respect to a change in the market price. So we substitute the expression from previous page for the change. We get this mass, and just going through with some routine mathematics, it turns out that we have an expression with a couple of constants applying that basically is a very close approximation to the average error variance for investors, average across the whole market, weighted by the wealth. And so basically, we end up with drawing attention to this ratio. The ratio of the actual distribution of estimation errors made by the investors of the market to what they thought their errors was going to be. Well, in my mind, this is the very definition of hubris. The smaller the denominator, the smaller they think their actual errors are, the more hubris. or figure the numerator, the actual rate. So basically, if you buy my notion of a market that can be rational so long as individual investors adjust their opinions once and only once to new information. If you buy my assertion that such a market can be rational, even though the wealth effects are going to prevent price changes from being random, even though investors' opinion changes, individual changes. If you buy that, then we not only have a demonstration of exuberance, but we have rational exuberance. Okay, so much for market bubbles. Now, I laid out the basic idea of how I see momentum stocks being linked to market bubbles. But let me review that now. It works because when you make a bet on a stock, the doesn't care about your motive. You get the same reward when the price changes, no matter what the actual reason for the price change was. We all know this. But in particular, again, if we make bets on specifics of a stock, and the stock has some sensitivity to the general market, when the market goes up or down, we get rewarded or penalized for that bet on specifics. That induces wealth shifts among the people who are betting on that particular stock with regard to specifics. And that wealth shift, in my kind of world, where equilibrium prices depend not only on investors' opinions, but also on their wealth, that wealth shift then changes the way the market prices the specifics of the stock. It's made people who are bullish about the specifics richer, perhaps, and it's made people who are bearish about the specifics poorer. And that is going to change equilibrium price. Are you arguing, trainer, that there can be bubbles in individual stocks? No, that's not my judgment. It may be your judgment. You can disagree with me about this, many things. The reason I don't think you're likely bubbles in individual stocks relates back to our holding rule, that the size of bets basically is a product of disagreement and wealth. When we get this kind of wealth effect on an individual stock, and we got a change in the equilibrium price of the stock, that holding rule, that betting rule, says, hey, now we have to change, because we're changing our wealth, which we're changing all our bets. Okay, it's the same wealth that goes into our bets on all stocks, our bets on the general market, our bets on global markets, the foreign market. that's why I don't think the bubble model per se is a good way to explain momentum stuff. A wealth change generated by one stock then tends to change bets in all the investors' positions. It gets diluted. 100 stock mutual fund, it might get diluted on average by a factor of 100. An individual portfolio, investor portfolio, 5 to 10 stocks, it might get diluted by a factor of 10. At the next round of changes in actual price, wealth shifts, changes in equilibrium price, it gets diluted by another factor of 10 or another factor of 100. It just seems to me that after a few repetitions of this process, a bubble in an individual stock is going to peter out. But this is not a problem for our momentum stock mechanism. As long, again, as the bubble continues in the general market, and as long as there's agreement about the specifics of the stock, with some general market sensitivity, every round price change, wealth shift, change in equilibrium price is going to change the way the market values the specifics of any stock that investors disagree about. So again, as long as the bubble in the general market continues, and as long as people continue to disagree about the stock, the momentum in the stock will continue. Why will some stocks be momentum and others not? Again, the stocks with momentum will be the ones with the big disagreements. I'm not sure what you'll think of this. It seems to me that if I were in the position of saying, well, look, there are thousands of stocks out there. If I knew which stock to investigate, I could probably find something interesting with real investment value. But where among thousands of stocks should I look for a promising candidate for research? Momentum stocks. Momentum stocks, if indeed they are, our trainer says they are, stocks with big disagreements. You know that at least one side of that disagreement is going to turn out to be wrong. Very likely both sides, but at least one. So the reward for researching a momentum stock just on a priori grounds is better than the reward for researching a stock that is not a momentum stock. Well, I'll be interested in what you think of that kind of argument. Systematically, every time important new information arrives that relates to the general market, the impact of that new information is superimposed on any market bubble process. is going on. You get further change in actual prices, further wealth shifts, further changes in equilibrium price, and then having done that at the next round, you've got a bigger change in actual price, a bigger wealth shift, a bigger change in equilibrium price. The arrival of new information changes the velocity of a market bubble. Obviously, in either direction. It's algebraic, depending which way the bubble is running. News can either accelerate the bubble or slow it down. Okay, but if the bubble in the general market is what is driving momentum stocks and creating this incidental, and perhaps in a way slightly illogical, wealth transfers in stocks where investors disagree. New information affecting the general market level that changes the velocity of the general market bubble, changes the incidental impact on specific stocks where investors disagree. Changes the specific return on all such stocks, all stocks where investors significantly disagree. They all change at the same time. So this kind of change in the velocity of the general market bubble has a systematic impact on the velocity of all the momentum stocks. It hits them in the same direction at the same time, with big information on the general market having a big impact on all the momentum stocks at the same time, and small news about the general market having a small impact on momentum stocks at the same time. So let me review. I've tried to argue, subject to your judgment, that a useful way to think about securities markets is one in which individual investors appraise new information rationally, but because equilibrium prices depend on wealth as well as opinion, the wealth effects that I've tried to speculate about are not random, but self-regenerating, so that we can have what I would call a rational market, namely a market populated with rational investors, without having random price fluctuations in equilibrium prices because of the wealth effect. So much for the question about rational markets and how to reconcile momentum stocks and bubbles with rational markets. We've seen also that systematic risk is not implausible, that momentum stocks should have their own brand of systematic risk. Now, I want to leave plenty of time for questions. And I just hope that the questions won't be too tough. Yes.
First of all, let me say I am a little bit stupid about this, but would the opposite logic be true then? Would the momentum end when you have negative information on the only end, I should say, when you have negative information on the entire market and the entire bubble, and the bubble starts going down, or can it end of its own accord? We've talked about them gaining momentum, but we haven't talked about them losing momentum. Am I correct?
Okay, you make a very good point. The thing is, definitely, I can work both ways. To make it the most obvious example, you can have a positive market bubble with positive impact on momentum stocks, and then you can have some very bad news hitting the general market that basically ends the market bubble. And if Traynor is right that individual stocks can't sustain that kind of bubble without the continuing impact from the general market, then at that point, not only would the market bubble stop, but the momentum stocks will also stop. Yes.
Sure. Question is, have you looked at your theory if you have a leverage? The leverage effect, how it's going to change the equilibrium?
Well, I used a simplified model, as you saw, simplified that way. I haven't really thought about it. I'd like to think that all leverage does is make the explanation more complicated, and that the practical effect of leverage would be to raise the intelligence level of your speaker, would be required to. But you're right, a really complete model should certainly not work. Sure.
Yeah. I'm a little queasy about your explanation of individual stocks. Hard to get them into a bubble, much easier to get the market into a bubble. Every bubble has been pushed by some small segment of the market. So maybe not an individual stock, but certainly a sector. Think of technology or biotech. And it seems that you can move away from reality in some section of the market. I'm not sure how you pull that back from, how you conclude that an individual stock is much less likely to be in a bubble than the market as a whole. Certainly, I don't think the argument holds for a sector. How do you push it back to the individual stock level that this can't happen?
Well, I'm not sure I understand the question.
Well, let me put it differently. It's certainly not hard for collections of similar stocks that represent a reasonably small fraction of the market to experience a bubble. You can think of them as proxies for each other. Each stock in that small subgroup is experiencing a bubble. If I heard you seem to be arguing that it's quite hard for individual stocks, which are a small fraction of the market, to experience the bubble. I'd say, look, it's possible for small fractions of the market to experience a bubble, and that is in fact what we have experienced.
Well, I think you may agree that the related question is, what about the Fama French factors?
Yeah.
Would a single Fama French factor, a small stock factor, or a price to book factor,
Yeah.
would that involve enough stocks so that in generating wealth changes, enough of the wealth changes would be fed back into that particular subsector to keep the thing going?
Absolutely.
And I don't, of course, I don't know the answer, but it seems plausible. It could happen.
30 years ago, Herbert Simon won the Nobel Prize in Economics for, among other things, theories of bounded rationality, suggesting that there are computational bounds to the decision-making processes. Over the past 30 years, there have been numerous developments in behavioral finance. Daniel Kahneman won the Nobel Prize. Have any of these findings impinged on your model?
Wow. I guess the way I would answer is to say that I'm kind of the task I set for myself was the most rational possible explanation for Millennium stock that I could find. You can judge whether I've gone in the right direction or not, but in trying to understand markets, I always defer irrational explanations as long as possible. Obviously, a lot of the current literature on common and diversity kinds of things, it doesn't affect market prices unless it has a systematic effect on a lot of investors. But it's certainly you can plausibly for certain kinds of irrationality. So I'm just trying to avoid the appeals to irrationality as long as I can. Good question. Liz.
Maybe kind of a similar question, but when you're thinking about the level of uncertainty, are you using volatility as a measurement to establish that, or?
You're talking to Ethel Lynn. All right, Peter, thank you. In talking about uncertainty, am I using volatility basically as my concept of, or my measure of uncertainty? One way of thinking about the relation is that nature makes forecasts, and his forecasts successfully predict some fraction of the actual price change. If you can contemplate, take seriously contemplating a kind of a long time sample for the investor, in which it's meaningful to talk about a kind of an average fraction of the actual price change that he successfully anticipates. Then uncertainty for that investor is basically the fraction of the actual volatility that he failed to anticipate. Yes.
I think your focus on the effects of redistribution of wealth in the market is a really good one. But behind your model, there are a couple of assumptions about the dynamics of what's going on behind the scenes that if you brought them out into the model more formally, would make it a lot richer. So, for example, you're assuming that the response to wealth changes takes a little bit of time. So the market goes up 1%, and a stock that has a beta of 1 also should go up 1%, but that will then generate new wealth to the winners. That'll push it up another, let's say, 20 basis points. If that happened real fast within the course of a day, all you'd see is that the effect is market goes up 1%, the stock goes up 1.2%. It looks like it has a high beta, but you wouldn't see the momentum, which involves sort of a slow adjustment. On the other hand, you're assuming that the people don't adjust their expectations in response to what they see in the market at all. It's not like the winners think that they're smarter and then take bigger positions, and the losers think, gee, maybe I didn't know so much, and reduce the fraction of their wealth. And so those things also would make your model a little bit richer and generate more complex kind of responses.
Yeah, I was hoping nobody would bring up the subject of time. One crude way that I think about it for myself is that information arrives, the impact information arrives in the market with dramatic impacts. And then between the arrivals of new information, you have these little things going on that Trainer's talking about. And until the next arrival of new information, and then pow. But you're right. There's a real awkwardness in the way I think about time and the gradualness of this process, and how it feeds on itself. So, I'm weak on this. Yeah. So,
Jack, what is your definition on momentum stock? And how do you assign a value on the momentum stock?
how do I?
First is, what is your definition of momentum stock? And how do you assign the value for that stock?
Yeah, okay. Empirically, any good theory should translate into empiricism and testable results. It may be that the things I'm talking about are so faint that they're just overwhelmed by the arrival of new information and so on. And that's going to make it very tough to do any meaningful tests. I'm not sure. Sir.
Jack, with regard to empiricism and trying to test your idea, if there was a different distribution of wealth across the investors in a particular market versus another market, would you expect a greater frequency or magnitude or severity of bubbles?
if there was a different kind of distribution of wealth,
Yeah, among the
with
investors.
maybe a few very rich people
Yeah.
and a lot of very poor people.
Right.
Interesting that you raised that question, John, because in modeling this thing, I explicitly assumed that $1 million accumulated from 1,000 investors, each of whom had a wealth of $1,000, would have exactly the same role in my model as $1 million from one investor whose wealth was $1 million. And that I wasn't going to try to discriminate between the role.
Yeah, if there was a discrimination that made sense, and maybe you could do some testing by looking at different national markets at different periods of time in the past, where you might be able to get a sense of a much different distribution of wealth in Holland in the 1800s, maybe than the United States in the 1950s.
And maybe I could use that to develop some meaningful
Yeah,
tests.
so maybe yourself or some graduate students or something might be able to comb through history and make some empirical tests.
If anybody here wants to nominate some graduate students.
If you look at the market today, if you look at the U.S. versus Japan, it's quite an interesting difference that impacts on your ideas. And let me ask you a question. If you look at the U.S. market, it turns out the momentum obviously exists, and stocks with high estimate dispersions have more momentum. So estimate dispersion higher means the momentum is more impactful in the U.S. market. In Japan, momentum tends to be poor, and high estimate dispersion actually reverses the effect. So in the U.S. market, your ideas explain very well the data. The question is, and maybe an observation relative to the question there, is why does Japan, how could culture change your model? Because in Japan, it seems to be just the opposite of the U.S. with respect to uncertainty. So the U.S. market support, the data U.S. market supports, highest dispersion has higher momentum, which is fairly consistent with your ideas about disagreement. So I think the U.S. data supports your thesis. In Japan, you have the opposite effect. The momentum is poor, high dispersion hurts momentum. So this agreement is a negative momentum in Japan. So how would you account for cultural differences?
Well, I confess that I tried to pretend that I was developing a general theory of momentum study, but I was pretty guilty of just thinking in terms of U.S. experience when I was working on it. I'm sorry to hear that Japan is an awfully counterexample.
Well, it may not be counting, so maybe that disagreement has a different role. Maybe a good example, but it's a different attitude towards disagreement. So there could be a preference topic.
Is this? We've got to think about that. Thank you for your patience.
I want to say a quick couple thank yous. First of all, to Jack Traynor, of course, for speaking tonight and for being the FEOY for 2007. He joined us at the dinner back in February, and he flew out last night with his wife Betsy. And so thank you very much, and congratulations again. Also want to thank PricewaterhouseCoopers, a gold sponsor of the IFB, and also provides us with this beautiful space many times throughout the year, right here at 42nd and Madison. IFB members like being in Midtown, so thank you to PwC.